2023 May, Money and Banking. So section A of this paper was multiple choice. So in this multiple choice section, we have quite a number of questions. So before we answer these, I'll just need us to go through a few basic principles. The key thematic areas that we covered here. So we had discussed in our previous classes on issues to do with money and banking, having to look at issues of financial um, intermediation and asymmetric information. So this is an important concept. So quickly, what is a financial intermediation? So when dealing with financial intermediation, we are looking at financial intermediaries that act in the financial mediation like banks and credit unions. So these um, channels through which funds move from the savers to the borrowers. So one of the key reasons for their existence is financial information asymmetry, where a situation we have a party in a transaction who is usually the lender has less information than the other who's a borrower. So that situation is called information asymmetry. So this can cause diverse selection problems and moral hazard that can lead to inefficiencies in direct financing. Then we also should understand the concept of SMEs. These are particularly affected because they lack the public disclosure or credit history that large firms have. So it usually makes it hard for them to borrow bonds and stocks directly. So in financial mediation, we acknowledge the role that financial intermediaries play in reducing the transaction costs and gathering more information to assess risk. So the role of financial intermediaries basically is to bridge the gap between surplus and deficit economic units. Another concept we talked about is the issue of time value of money. So we can also apply this from our corporate finance. What is time value of money? So time value of money is a concept or principle that the sum now has a greater value than tomorrow. So we use compound interest, simple interest models to compute how much the future value would be. So you can evaluate how much your money is now to tomorrow and compare the two. Yield to maturity is the point at which IRR is equal to zero. It is the IRR earned by an investor who wants to buy a bond and holds it until maturity. So it equates the net present value of all cash flows with the initial investment. So if you're calculating a loan, for instance, of 5,500 to be repaid in 2 years with that annual payments of 2,850, this can be estimated using financial calculator models. So IRR is given as a point at which NPV is equal to zero. You remember the formula for IRR?
No, not off the top of my head.
Okay. So the formula for IRR. So some of the questions will ask you to calculate this. Formula for IRR is equal to um, NPV you use interpolation usually instead of using the calculator. So we have NPV over divided by PV1 minus NPV2 two, that's one. Um, that's the answer there. Okay, so it's an important model that we use when calculating the discount rate. Okay, so IRR is simply a point at which NPV is equal to zero. So this is a concept under capital appraisal methods that investors use to evaluate whether their investments are worthwhile. Okay, so we also have the concept of yield to maturity under capital appraisal methods. So yield to maturity is very important because it gives us the appropriate discount rate. So it is a total return anticipated on a bond until it matures. So it considers coupon payments and any capital gains. So YTM equates NPV of all future cash flows to the price of the bond. It takes account of time value and assumes all coupon payments are reinvested at the same time. So this is a formula for YTM. Okay, so we also uh, consider the concepts in money and banking to do with the functions of money. So what did we say with the functions of money? So money is a medium of exchange. So it has several functions that we need to know. It has a store of value, meaning it retains the value over time. We're told that money is a unit of account, meaning it's a standard for pricing. Money is a standard of deferred payment, so it is used to settle debts, in contrary with the old systems of barter system. So you can serve in monthly installments to store value as a function. We also talked about the monetary instruments that the Bank of Zambia uses or the federal government. So there are tools that the monetary policy would make use of, what we call direct and indirect monetary policy tools that will influence credit and money supply through the mechanisms. So we talked about what is called the OMO system. We talked about the cash reserve ratio. We also talked about the statutory liquidity ratio. So now what are these and how does the um, Bank of Zambia use this to control money? So these are indirect tools. So OMO means open market operations. It is referred to the buying and selling of government securities like treasury bills and bonds by the central bank. So when the central bank buys securities, it means it injects money in the banking system. Okay. So this move increases liquidity and we encourage borrowing and investment. When the opposite is happening, when the bank is selling securities, meaning it is borrowing money from the general public. So sometimes government would want to control inflation by reducing the flow of money in the economy. So they'll sell bonds, and when the bonds are sold, it means there'll be less money in the economy, thereby reducing the level of inflation. The other indirect way in which government will control money is using the cash reserve ratio. So this is a minimum percentage that commercial banks should hold or should keep as their book balance. So by increasing the reserve ratio, government is actually restricting money flow in the economy. So this is a way of improving or reducing inflation. When they reduce the reserve ratio, meaning they free up funds to lend out, so this will increase liquidity in the economy. The other way or indirect way that government could use control is the statutory liquidity ratio. So what's this liquidity ratio? It's a minimum percentage of a bank's net demand and time liabilities. So that must be maintained from liquid assets such as gold, cash, government approved statutory securities. So when you reduce the statutory liquidity ratio, the bank allow more lending, and this will allow for more investment, so to stimulate the economy. When they increase the statutory lending ratio, it means the bank is tightening, the effect is reducing the money available for lending. We also talked about some indirect tools that government uses to control the economy using money. What tools did we talk about? The indirect ways. Do you remember?
Sorry, please repeat your question.
We talked about the indirect ways in which the federal bank uses to control the flow of funds. Okay, they are direct and indirect. So the direct tools that the Bank of Zambia uses are more rigid and administrative in nature. They are less frequently used today in modern economies. We have what are called sectoral lending limits. So sometimes the central bank will give instructions directing commercial banks to allocate a specific portion of their lending to a certain sector, like agriculture, some SMEs. So this could be useful when they want to target inflation. Remember, we talked about inflation targeting. So how do these tools stimulate investment? The tools will stimulate investment in terms of boosting economic activity and investment. So the central bank will typically adopt expansionary monetary policy, like lowering the reserve ratio. So banks will have more money to lend to businesses, lowering the interest rates, um, so to reduce the cost of borrowing. Sometimes purchasing securities using the OMO system by selling bonds. Okay, so these are the systems that we had looked at in terms of government controlling our economy. Then we should also look at the three C's of credit evaluation. Three C's of credit evaluation. Do you remember them? So we looked at character, capacity, and capital. So these are the three C's we need to know. So when you're looking at three C's, when banks or financial institutions evaluate the loan capacity of an applicant, they will need to assess the creditworthiness using a framework that we know called the three C's of credit. So this will help the borrower to repay the loan. So the first C is character. Character here refers to the borrower's reputation, their honesty, and their reliability in repaying loans. So this is assessed using what we call a credit history or their repayment records or references. So when you have a good credit score, a consistent record of timely repayments, these are positive indicators of strong character. The other C looks at capacity. Capacity basically is an ability to repay a loan, which is based on one's income, one's employment stability, one's existing debt obligation. So capacity is evaluated through what we call debt to income ratio, their job stability, their cash flow analysis, especially for our businesses. So this is one which financial institutions use. And lastly is capital. Capital just looks at the borrower's net worth. what do they own in terms of savings or investments. So here lenders would want to assure security in their case. So they look at it as a safety buffer, okay, in terms of income loss or expected. So the last C is what? Capital. So these three C's are important. They work together to provide a holistic view that a borrower has in terms of the reliability and ability to pay. Then we have what we call the CAR, capital adequacy ratio. Capital adequacy ratio is important because it is a measure of a bank's capital relative to their risk. It protects depositors and promotes stability. So CAR is a key indicator when you're dealing with a bank's financial strength and stability. It measures how well a bank can absorb some reasonable amount of loss and still honor its obligation. Unlike the failure of the bank we had, which bank was that closed up? So CAR just gives us a picture of the ratio of the bank's own funds in terms of capital to its risk-weighted assets. So it ensures that banks have enough capital to cover the potential losses from risky assets. So it's given by Tier 1 capital plus Tier 2 capital over the weighted assets. So what is involved in Tier 1 capital? What is involved in Tier 2 capital? So Tier 1 capital basically includes uh, the core capital that includes equity, it includes disclosed reserved. So this is the first line of defense when it comes to losses for banks. We also have Tier 2 capital. Tier 2 capital involves supplementary capital reserves. Okay, these are hybrid instruments. They are subordinated debt. Then the risk um, weighted assets, we are looking at assets adjusted for risk, where safer assets like government bonds have lower weights and, and riskier assets like unused loans have higher weights. So we're going to see how we're going to use this CAR to calculate. So you may be given a, a table and asked to calculate what we call the capital adequacy ratio. So I repeat, this is a key indicator when I'm dealing with financial strength and stability that banks have. If we want to be sure that this bank is capable of honoring up, because investors sometimes will ask themselves whether it is worth investing some huge sums of money to a particular bank. So CAR is an important concept which looks at the ratio of capital, a bank's capital, their own funds against the risk-weighted assets. So it has Tier 1 and Tier 2 capital. So Tier 1 capital, this is the core capital that the bank has. It looks at equity. It looks at the disclosed reserves. This is the first line of defense when a bank undergoes losses. In Tier 2 capital, these are just additional capital like revaluation reserves, hybrid instruments, and risk-weighted assets. They are adjusted for risk. Okay, so I'm trying to summarize all the key concepts so that as we answer the questions, you understand um, what we are looking at. Then time value of money, we talked about the two interest rates that we will be looking at. There is simple interest and compound interest. So compound interest helps us compute the future value of an investment. It is given by present value 1 plus r to the power n. Depending on the number of compoundings, the r is divided by the number of compoundings, and the time is multiplied by the number of compoundings. So compounding is to add or end interest. So if it's compounded annually, our m is equal to 1. If it's compounded semi-annually, our m is equal to 2. If it's compounded quarterly, our m is equal to what? 4. If it's compounded monthly, how many months are there in a year? 12. So if you have 10,000 kwacha, which is invested for 5 years at 5%, the future value is 10,000. 1 plus R, so 1.05 to the power 5. So you're going to get something like 12,000. You expect this much in 5 years. This is when it's compounded annually. When it's compounded semi-annually, the effect will be that we are going to divide our interest by 2. So this will be 10,000. 1 plus 5%. So the more you compound, the more interest you earn. Divided by 2. Then you multiply the 2 times the 5 years. If you compound quarterly, we'll put a 4 here and put a 4 there, multiply by that. Monthly, 12, and 12 there, multiply by the 5. Okay, so the more you compound, the higher the figure you get. So this also helps us calculate what we call the effective annual rate. This is a real return, a real investment that you have on an investment. So it's given by 1 plus R over M, the power M minus 1. Has nothing to do with the number of years here. So sometimes it's called the APR, or the annual percentage rate. So if you're given this 5%, compounded quarterly. So 0.05 over 4 to the power 4 minus 1 times 100, the final answer. And the present value, if you're using simple interest is simply going to be what? PTR. P is the principal, the amount we have now. T is the time. And R is the interest rate. This one works like an arithmetic progression. If your initial amount you started with is 100 kwacha at 10%, so you'll be getting 10 kwacha every. The other important concept we have talked about is an issue of credit bureaus. What are credit bureaus and what are their functions? So in dealing with credit bureaus, they're very important in every nation because they're independent institutions that help to collect, to store, and to share credit information about an individual or businesses. So the data that they have is used by lenders to evaluate the creditworthiness of potential borrowers. So what's the function of a credit reference bureau? And what benefit do they have when it comes to the financial institutions? So the Credit Reference Bureau is got the function of collecting data from banks and financial institutions and other lenders. So it compiles these credit reports, which are used for loan repayment history, for outstanding um, debts, for default or late payments, for a number of credit inquiries. So it aligns the credit scores based on the borrower's repayment behavior. So they are very beneficial to the financial system because they help to improve transparency. So lenders have access about an individual business, okay, to reliable borrower data. It reduces what is called adverse selection. It helps preventing lending to high-risky borrowers. It encourages responsible borrowing, and borrowers are more likely to repay on time to maintain a good credit score. So in Zambia, we have what we call CRB as an example of such an institution. We have theory when it comes to um, interest rates and we have what we call the loanable funds and interest rate equilibrium. So we have the loanable funds theory, which explains how interest rates are determined in the free market by the interaction of supply and demand. So the key concepts we need to understand are supply of funds. How do they come? They come from the savings of people, the savings of businesses, the savings of government. And the demand for funds, it comes from investments, investment needs like borrowers seeking loans for businesses, for homes, for education. So interest rate equilibrium. The interest rate adjusts to balance the supply and demand. So at equilibrium, the interest rate, the amount saved is equal to the amount borrowed. So we have the equilibrium that we have. So what happens at equilibrium? So if the interest rates are too um, low, the demand for loans will exceed our supply, so there'll be a shortage of funds. Again, this will create an upward pressure of the interest until the balance is restored. So if the interest rates are too high, supply will exceed demand, so there'll be excess funds. So this will cause interest rates to fall back to the equilibrium. So this is a behavior that happens in here. So how is the determination of interest rates? How is the determination of interest rates done in the free market? So we have what is called the real interest rate. It reflects the true cost of borrowing after removing the effect of inflation. So the real interest is equal to the nominal interest rate minus inflation rate. So the key determinants of and the impact are number one, increasing savings. So when you increase savings, you boost the supply of loanable funds, and this will lower the real interest rate. When you decrease investment rate, there will be less competition for funds. So the real interest rate will do what? It will fall. If there's increased borrowing or demand for funds, it will ensure the interest rates will go up because the demand for funds is high. The other determinant of real interest is political and economic risk. So lenders will demand what is called the risk premium. It is higher in um, economies that are unstable politically. All right, so the real interest rate, in essence, adjusts according to the balance of payment and investments and risk profile of the lending environment. Okay, so we look at now the breakdown of financial markets. Look at the breakdown of financial markets and also the money market instruments. Then I think we can be ready to answer some of the questions in multiple choice. All right, so here's a breakdown of financial markets. So financial market mechanism occurs when there is a normal functioning of financial institutions and systems. So financial market breakdown is simply a normal phenomenon that happens when the normal functioning of these financial institutions and systems is disrupted, and this has consequences. So the major consequences that we have when there's a financial market breakdown is number one, there will be credit freeze. What happens when there's credit freeze? When the credit freeze, it means banks and lenders become unwilling to lend. Businesses and consumers cannot access these funds that are needed to operate. The investment and economic activity will go down. Secondly, there is loss of confidence. Investors, um, depositors will panic. So the banks and the stock market will sell off and to worsen the economic crisis. The trust in the financial institutions and government will decline. Other consequences of financial markets breakdown will be that there'll be slower economic activities. So businesses will cut down and lay off workers. Consumers will reduce their spending due to uncertainty, and there'll be a lack of credit. So this will lead to a full-scale recession or depression of an industry or an economy. It will also lead to political and social instability. So there's high unemployment, and there'll be uh, inequality when it comes to um, the economy. So it can lead to protests and strikes and also political unrest. So governments may be forced to intervene with bailouts and policy changes. So we have an example of the 2008 global financial crisis, which led to massive credit freezes and recessions. So the concept also in the money market instruments. So what are money market instruments? These are short-term debt instruments that are used within a year. So we have the commercial paper, the treasury bills, certificates of deposit. So these are instruments that are used in the money market. So what are commercial papers? What are treasury bills? So just briefly to explain these ones. Commercial paper is short-term debt instrument. It is unsecured, but issued by corporations. It's used to finance payrolls, inventory, and short-term liabilities. Their maturities are up to 270 days. Treasury bills, these are short-term debt instruments that are issued by government, Bank of Zambia, or US Treasury. They're considered to be risk-free. They're sold at a discount and redeemed at face value. We also have certificates of deposit. These are time deposits issued by banks. They have a fixed maturity and interest rate. They can be negotiated or negotiable. Okay, they are tradable in the secondary market. So we also have capital market instruments. What capital market instruments do we know? What are capital markets?
Capital market instruments, bonds, stocks, amongst others. What are capital markets? These are the markets in which longer-term financial instruments are traded with a focus on capital gains or what do you call them? Yeah, anyway, I'll give you that for now.
Yeah, for more than a year to facilitate raising capital for government and corporations. They are used to support long-term investments. So examples, we talked about what? Stocks and what? And bonds.
Bonds,
Yes, and also preference shares. So the stocks represent ownership of a company, and shareholders will receive dividends that can also allow them to vote in corporate matters. So they're traded on the stock exchange and they provide capital appreciation for longer investments. So the debt instruments we can have could be long-term bonds, debentures, okay, which are issued by government and corporations and receive a coupon, which is regular, based on the principal. So types we have GRZ bonds, corporate bond, multiple bonds. They have lower risk than equities. So we also have preference shares, which include hybrid instruments, the features that have both debt and equity. Okay, so that is with regards to the money market and capital markets. Another thematic area that we need to look at is that to do with the structure of interest and yield curves in the money multiplier. We talked about the money multiplier last time, what it is, and how important it is in our field of study. So let's look at the term structure of interest rates and the yield curves and also the money multiplier. In our next session, we can now start answering those questions. Okay. So what is the term structure of interest rates? So by the term structure of interest rate, we are describing how the interest rates or yields vary in terms of the length of maturity and also in terms of the debt instrument. Typically, we're looking at government bonds. So we have types of yield curves. We have what we call the normal, we have what we call the inverted, we have what we call the flat yield curve. The theories that we use to explain these ones, we use expectations theory and the liquidity